I'm going to kick off this conversation by stealing one of Lisa's questions to start 2025. Are stocks too rich or are bonds too cheap?
Well, I think we have a backdrop. I think your point about the U.S. and China and Europe and the three parties, it's our view that and Torsten has been very consistent. The U.S. economy has been the beacon of opportunity in the last several years. Strong economic growth, capital coming in from around the globe. And so in terms of, I don't want to talk about the stock market, I'd rather talk about the underlying economy.
Sure.
Underlying economy looks like it's the place to invest. I don't think it's any surprise that when you peel the onion back, private capital, which has really been embraced in the U.S. and gives diversity of funding, lets companies grow, start, expand, and all the things we're talking about, the global renaissance, it's been the place to invest and it's been attracting capital. Contrast that to what's going on in the UK and continental Europe, where they are stuck in a financing system that's really 15, 20, 30 years behind the rest of what's going on in North America. It tells us that the U.S. is the place to invest.
So you think some of these problems in Europe might be more structural in nature?
I think structural is really the key to really analysis. It's very easy to focus on the last 3 to 6 months. We talk about the Liz Truss moment in the UK. I think it is a great reminder for this current administration as they've got great ambitions in terms of U.S. investment, CapEx, tariffs, immigration, a variety of other big initiatives. It's good for this reminder of the Liz Truss moment in the back of their minds to know what can happen if you lose confidence. But there's no doubt, I think, if you look at what the Draghi document did, later last fall, he pointed out in 158 summary pages of all the challenges that they have not really embraced. And while the banks are in better shape than they've been in a couple of decades in Europe, the U.S. is the standout. We have the greatest financial services sector in the world. We have the deepest, broadest capital markets. We've undergone a tremendous amount of regulations on our banks, and they've continued to thrive in a more narrow world. And that's the page that the Europeans should be looking at, embracing securitization, embracing private capital. They've got a massive amount of infrastructure needs, and they should be embracing that for their long-term economic success.
In the meantime, people are saying that maybe the ghost of Liz Truss is kind of hovering over this administration and hovering over the U.S. Treasury market right now, especially given the rise that we've seen in longer-term yields. And I'm wondering how susceptible you are to changing your view on how constructive the U.S. economy is if you get some more negative data prints. We had Greg Dako yesterday talking about a frozen job market. We had Neela Richardson talking about how smaller companies really are feeling rates where they are.
Rates have been higher for the last 12 to 18 months. They've been higher. Obviously, we're in a period right now where what the Fed did in its actions in the fall and what the market has responded to is a very unique period. So you're right. We are in a little bit of a unique zone here with regard to macro and rates in the U.S. I do think we are in a period where rates do look attractive versus where equities are. And we're in a period right now where we're still the place of economic growth, but it is a warning sign for the administration about how much they can push. Now, clearly, the other side of the trade, I would not probably be lowering rates right now. I think that you have full employment, economy's doing quite well. I'm not sure I see a need other than economic textbook to lower rates in terms of the target, but it does create a lot of room for the new administration if they have weakness in any kind of the economy because of their initiatives. The Fed put us back, they have a lot of room to move.
Your colleague is sort of edifying your points as you say them, Torsten Slok, moments ago. Inflation reaccelerating, to your point about not necessarily needing to lower rates further. You talk about credit being the sweet spot and debt, maybe even over equities. And that has been the story over a long period of time, this past couple of years. If inflation could be reaccelerating, could you see that story changing at a certain point?
Yes, you could, and I guess listen, there's a lot of consensus out there about where the S&P is going to go, where rates are going, but in our view, in the backdrop, the U.S. economy is still the strength of the globe. It's the beacon of economic opportunity. We still have a lot of economic growth in terms of the industrial renaissance that we've been talking about. So, in our view, the breadth of credit, investment grade as well as non-investment grade, we try to find areas of dislocation or areas of mismatch of capital and opportunity, and we're still seeing it in credit versus the equity markets. Now, when you look at the S&P 500, I would say that it's interesting. We all know what the Magnificent Seven are, but certainly the other 493, a lot of unloved opportunities in that basket. And there's probably an opportunity in a non-consensus view in terms of those companies, in terms of just pure economic growth. But we are still, listen, private credit and private capital has been the engine of economic growth in the U.S. And I will, again, I said earlier, it's not a great irony. It's a great irony that the U.S. has been the bastion of economic growth with the embracing of private capital. But, one of the greatest investors in U.S. capital history, Warren Buffett and Berkshire. When you really pull the covers back on Berkshire Hathaway, of the $1 trillion of assets at the end of 23, 30% are in the public equities that we know about. Apple, Coca-Cola, American Express, B of A. But 70% are private companies. It's the growth engine. He's the greatest capitalist. He's been doing it for 50 years. That's where growth and opportunity is in America. Private capital in private companies. And they have access in the debt markets. They don't need to go public to raise capital anymore. 8,000 public companies to 4,000. That's the trend in the future. And we're sitting really at an intersection trying to bring those opportunities to the broad group of investors, retirees, and savers around the globe.
So you mentioned Europe, and Europe, certainly, the bank channel is overburdened. We've been talking about this for years, the Europeans have. Draghi talked about trying to do something with public markets in the same way we have here in the United States. It's not happening. I want to understand from your perspective how you will work with the banks in America going forward from here, because there's a start of a new trend where the banks will originate the loans and then you'll provide the money. How's that going to work in years to come? How big could that opportunity be?
Oh, I think 24 was a pivot year. For us as a leading firm in this industry and in this sector, there was a great headline, and you and I talked about, the three of us have talked about on this show many times, where the great battle between private capital and banks. The reality is, if you look at the commercial dialogue going on between the top 5, top 10 institutions and the handful of us that lead our industry, the amount of integration, dialogue, working together on big deals has never been deeper. Obviously, there was our Citigroup transaction. There was a transaction we did with Standard Chartered, BNP. And so I think we're still at the early days. These partnerships need to have substance. They can't be, excuse the phrase, shotgun marriages. They have to be ones that really have substance, dialogue, trust, and some history of doing a lot of transactions together. We've been fortunate in all the ones we've put together where there has been a lot of either history of personnel or of activity. But I think still it's early days, early innings. Now, there's a lot of headlines just to grab headlines, and there's not a lot of substance behind them. But I think that trend of private capital and bank partnerships is going to extend in 25 and 26. And I do think, if you think about the economic backdrop, I do sense that there is a great opportunity for strategic M&A. That clearly feels like it's going to happen. I'm a little bit more skeptical about the massive IPO window. If you look at the last 10 years, equity issuance has been about $250 billion, 50 billion IPOs, 200 billion secondaries. That's removing all the SPAC numbers. I think you still have a valuation issue with a lot of private equity companies that want to come out and do their IPO. And so I think we have a consensus view or non-consensus view at Apollo that number is going to be not as large as people think. And so the big mismatch, if you have a big credit market, a big equity market, this area of hybrid in between, which we've been talking a lot about, applying capital to those over-levered companies, that's the opportunity of 25 and 26.
Just to build on the IPO issue just a little bit more, is that just a valuation issue, or do you think it's a role that you have to play here, that these companies don't need to go public anymore?
It's a combination of both. It's a great question. I think it is a valuation issue for probably 50 to 60% of them. I think it's very, very clear now private companies have access to all sorts of capital, debt and equity, preferred, convertible, whatever it may be. And so the typical route where you needed to go to have your employees be able to monetize their investments, broad-based capital, equity, revolvers. You saw what OpenAI did several months ago, bringing in a bank facility. there's tremendous pools of capital, private capital, that can fund and finance these companies. So going public is by no means the ticket to liquidity that you needed in the past. A lot more options.
In 5 to 10 years, will there be a difference between public and private markets?
We don't believe so. I think there will be some differentiations, and I think the question that gets raised right after that question that you ask is, well, is there going to be a massive compression in yields? And the advantage is going to go to those folks that have the bigger, you're going to make money on the origination. The ability to make the $3, $5, $7, $10 billion commitment to XYZ company, that's where you're going to garner the extra spread. But all the things that we're doing in origination, in capital formation, in trying to bring some liquidity to these markets in terms of secondary activity with transparency and price discovery, I think the barriers and what's private is risky and what's public is safe. I think those barriers will be coming down. And again, I go back to this Berkshire. No one really talks about it, but it is quite an irony that the greatest public investor of all time, 70% of those companies, when you look at the web page, these are some great American companies. And over 50 years, he's assembled them, and they're massive compounders. And that's 70% of the underlying value. Geico being at the top, Clayton Homes, BNSF, many, many other great companies. And I think that's a lesson for us all. There's companies that are private, and there's private equity. You should differentiate between the two. But we clearly want to be part of that big trend and offer those to investors and retirees around the globe. It's a big change in market structure.
Jim, I've got to ask you this, and we can move on quickly if you want to. How close were we to losing Mark Rowan to the swamp down in Washington, D.C.? How close did we come?
Well, I think that the administration saw an amazingly bold thinker and who would have had a huge impact on the future trajectory of our economy and our the far-ranging responsibilities of the Treasury Secretary. And I think he was, very engaged in the process. But America's loss is Apollo's gain, and we certainly feel we have a great, deep management team that could carry the water in his absence. But he was very engaged in the process.
Let's build on your gain, and that's diplomatically put. In early November, when we got this election outcome, your stock was like a rocket. What were investors seeing? What do you see as an opportunity of the incoming administration? What kind of changes are you expecting that might benefit your business?
Well, I think they've seen, in our particular example, we've been a company that has grown over the last decade by being at this intersection between retirees and investors around the globe and companies needing to raise capital. And as the markets have evolved, we've continued in a low-rate environment and a high-rate environment. We've been able to continually, 15 to 20% growth of our business every year. And they see that in an environment where we're going from an administration that was clearly not pro-business and not as pro-growth to one that clearly is pro-growth, a regulatory environment that clearly has changed. So I think the view has been, if these folks have succeeded so well in an environment where there's been an administration that was not cheering them on to one that's clearly cheering them on, that's a better backdrop of a broader success. And I think that's what we're seeing right now. Certainly the refreshed view of a regulatory backdrop, this refreshed view of M&A, the refreshed view of bringing capital into the United States and having capital really provide a lot of this growth, whether it's in technology, whether it's in the onshoring of companies. We're feeling the backdraft of that, which I think is very, very positive.
Well, I want to pick up on that, the idea of financing some of the technological advancements. We've heard a lot about that, whether it's some of the warehouses, whether it's some of the energy grid. What areas is Apollo going to double down on as a result of maybe more free permitting, more acceptance, and frankly, some of the sentiment that you were talking about?
I think you've identified them. Certainly when you look at the big TAMs of infrastructure, of data centers, of the utility grid, of that broad infrastructure, all of those by many, many investment-grade companies, even the highest-rated investment-grade companies. Witness what we did last year with Intel. There's a whole slew of those that are looking at massive CapEx needs, and we've talked about it here in the past. As much as the investment-grade market is a very robust, open market, a lot of the growth that these companies are confronted with are well in excess of what can be financed purely with the investment grade market with their existing ratings. So you've identified 4 or 5, and they're really in those big pools of economic growth of infrastructure, technology, digital, data, all of those areas, which many U.S. companies, as well as the onshoring of foreign companies coming to the U.S., wondering how they're going to finance these activities. So, as I said before, since the Intel transaction, we have been incredibly busy. I would argue, I've used the term phone ringing off the hook, about the dialogues we've been in with a variety of these investment-grade companies looking to finance their business in a variety of manners.
And certainly there's a belief that the incoming administration, Lisa, is going to have a more pragmatic approach to the energy needs that are going to be required to support some of these shifts. That's for sure.
With respect to drill, baby, drill, there has to be a host, though, of different energy provisions, and that's one thing that we keep hearing. Key question for a lot of people is how consistent can some of the regulatory parameters be, and that's why some of these connections are for many years in terms of the investments and some of the big tech companies that are making some of the financing.
Well, also, these are long duration investments. And again, this is another theme that really came to the surface last year in terms of what the market has really embraced is the duration of the capital that we have with our annuity and retirees that many of our peers have as well, but the scale and the integrated manner that we've brought that to the forefront, I think that's what the market has embraced.